Good evening, everyone. My name is Michele Ferrari. I'm the co-founder and CEO of StashAway. Thank you so much for joining us tonight. If you have attended one of our private equity presentations before, you know what we're going to do tonight, which is kind of presenting our next allocation to our PEVC program. I'm going to speak for most of the session, and my colleague Vincent, who is a wealth advisor with us in Singapore, will take over from me toward the end to explain how it works in practice and how he works and his colleagues, the other wealth advisor, work with our clients in helping people build their private equity portfolios. Today, we're going to talk about a fund called Hg Saturn 4, which is a European software buyout opportunity. And I'm going to go into the details in a second. Now, before I do that, just a quick reminder that I will try to take as many questions as I can. If you have questions, anytime throughout the presentation, please use the Q&A function that you'll find on Zoom to type your question, and I'll try to get to as many as I can toward the end. Okay, so let's start. As usual, I have a very quick introduction to StashAway at the beginning. We'll speak about private equity as a market, and we go deeper into the specific fund, so Hg Saturn 4. Now, first of all, what you see on this slide is our full offering in Singapore, from cash management to core portfolios, thematics, and alternatives. You probably have heard me saying this many, many times. Everyone should have 60, 70, 80% of your net worth in the core portfolio. Everybody should have 6, 9, 12 months of cash of your, 6, 9, 12 months of your expenses in cash. And then, whatever is left between, the cash that is your emergency, the core portfolio that, targeting your long-term goals, you can actually start adding some satellites, which can be thematics, or for accredited investors can include alternatives. So tonight, obviously, we're talking about alternatives. Specifically, we're talking about private equity venture capital. If you're not aware, we also offer a private credit solution working together with Hamilton Lane, and has done incredibly well since we launched it around 12 months ago. Now, but today is about private equity and venture capital. This is a program that we started around 3 years ago. The goal was to make 5 to 7 commitments per annum. What you see on the slide is all the commitments we've made, and the target is to invest, let's call it 100 every year. We've actually been a bit slower than planned, so we've done 200 over 2 years and 10 months. We started with Silver Lake Tech Buyout in June 2022. We've done a KKR growth commitment in October. Then we did the secondary with Lexington Partners, a large industrial buyout with Clayton, Dublin Rice, VC, Khosla Ventures, and mid-market buyout with Hg Capital. This was kind of the first 100%, the first year. And then we did another secondary with Hamilton Lane, mid-market buyout with New Mountain Capital, late-stage ventures with General Catalyst, Veritas Capital and Clear Lake specific, sector-specific buyouts. CVC Capital Partners, we invest in their growth fund, and Vista, again, is a kind of a sector-specific software buyout. And this was kind of the second 100%. And as you can see, Vista was actually done a few months ago. So the idea is that as you subscribe to the program, and if you actually stay with the program for a few years, over time, you'll build a very diversified portfolios of private equity assets, ranging from buyouts, growth, venture, and secondaries, which give you exposure to everything, with 65% focus on US, around 20-25% Europe, and the remaining Asia. We have been a little bit behind Asia because China has been difficult to invest in over the last couple of years. I am confident that in the future we can actually get back to our kind of a 10-15% target for China. I'm going to speak about portfolio later on. The goal here is, again, making it easy to build a real diversified portfolio of private markets, which is what GIC would do, which is what Harvard Endowment would do, which is what the Yale Endowment would do. So the large institutional investors, and so far has been I actually don't know anywhere else other than StashAway to actually be able to build such a portfolio. Now, I'm going to speak about 3 things. First, a little bit of an overview of private markets and why looking at that. could potentially make sense. If you've listened to some of this presentation before, this might be slightly repetitive. I apologize for that. There are usually some new information and some kind of updated data. So hopefully we'll keep it interesting. Otherwise, please just stay with me for the next 5 minutes, and I'm gonna go quickly through this. I'm then gonna spend most of the time going deeper into the specific fund, Hg Saturn 4, and then as I mentioned at the end, I'll leave it to Vincent to talk a little bit about how to get started if you are interested in investing through the program, or if you're already in the program, how what to do if you want to continue your commitment to Hg Saturn. Okay. Now, why private markets? What you see on the slide is kind of a 3 typical portfolios: a 40-60, a 60-40, and an 80-20. 40 equity, 60 bonds; 60 equity, 40 bonds; 80 equities, 20 bonds, with their relevant returns over 3 decades. So this is very long term, as well as volatility. On the X axis, you see volatility, so risk, and on the Y axis, you see annualized returns. And obviously, the more risk you take, the more volatility there is, and the more risk, then the more returns you can expect. So the more equity proportion you see kind of go top right. Now, if you add to each of these 3 portfolios an alternative allocation, and this is mostly private markets, what you can see is that volatility drops and returns go up. So this is a little bit of your overall goals, right? So if you look at your portfolio overall, you want to have as little risk as possible, as high a return as possible. And at whatever level of risk you're targeting, private markets help you achieve that. They increase your returns and reduce volatility at the same time. You'll see that there is a bigger impact on returns if you are taking a lower risk, and a bigger impact on risk if you're taking larger amount of risk. But there is a big impact either on one axis or the other. And obviously, if you are in the 60-40, there is a big impact on both sides. In absolute terms, numbers are quite significant. There is a 1 percentage point increase in returns for kind of the 40-60 portfolio, 0.5 percentage point for the 60-40, and 0.1, so a bit less for the higher risk portfolio. But as you can see, risk decreases very significantly by 3 percentage points for the higher risk portfolio. Now, the question is always, how do private equity perform over time in different scenarios? What you see on this slide, I think, is very interesting, and it's a comparison of private equity outperformance in different markets. So these are average outperformance basis points. So 952 means 9.5%. So average outperformance in basis point over 4 years, based on how the S&P 500 has done during the same 4 years. So on the left side, you see when S&P 500 has done poor returns, so less than 5% returns, then between minus 5% and plus 5%, between 5 and 10, 10 to 15, and more than 15%. So I want to point 2 things. First is that in all cases, private equity does better than public equities. So it is, and this is very long, this is more than 2 decades of data. So it tells you that irrespective of the market scenarios, over 4 years, so this is not yearly numbers, this is 4 years numbers, private equity always tend to overperform private equities tend to overperform public equities. The second piece of information you see here is that private equity tend to overperform more when public equities struggle. So in bad times, that's when private equity gives you the real diversification, while when public markets do particularly well, it's more difficult for private markets to actually beat by as much as they do in difficult markets. There was, in the last few months, you probably read a number of articles on, with people saying, hey, public markets will not return as much as they did in the past because valuations were high. In the meantime, valuations has corrected a little bit. But let's assume for a second that that's true and you believe in that, and the numbers you might have seen is that public markets were gonna, in the next decade will deliver only 3 to 5% per annum. Now, let's assume for a second that's true. That will put you in this kind of bucket in the middle, if you add 6.7% to 3 to 5%, it will give you a nice 10 to 12% per annum. And this is kind of median return. This is not top quartile returns. So the asset class clearly adds a lot to a portfolio by kind of increasing diversification and making portfolios more stable, especially when there is volatility. Now, and this is a little bit of kind of what I was saying before on at the average level. So in the light gray line is the MSCI equity world, while the blue line is all private equity and the purple line is only buyout, which is a subset of private equity. And as you can see, in the three-year rolling performance over the last 2.5 decades, private equity have always overperformed public equities, with the exceptions of 2012. I think that's the only point, and maybe 2004 is the only points where private equity has done not as well as public equity. So again, the point being, over stretch of time of 3 to 4 years, if you look at this slide and the one before, private equity overperforms public equities in practice all the time. And different view of the same data here. We actually, one exception to this rule that I just mentioned has been 2022. So the purple diamond is MSCI World, which is kind of the public market equivalent. The gray bars are buyout IRRs by vintage. So the 2002 vintage have done 25% return. That's how you, this is median. That's how you read the slide. And as you can see, in every year by vintage, buyouts have done better than public market equivalent, with the exception of 2022. Now, you could argue 2022 is too early to say, or you could also argue it was just going to be a bad year for private equity, or more importantly, it was going to be a good year for public equities, because people have bought at the bottom of the correction. So this is the assumption here is that you invest in the market during the same year. So, but overall, again, the message is, historically, private equity has overperformed public equities. And while I'm not saying you should put all of your money in private equities, what we have been saying to our clients over the last couple of years is, you should, if you are an accredited investor and you don't have liquidity concerns on a small portion of your total net worth, you should consider building over time a private equity portfolio. It will enhance your returns. It will reduce your volatility. It will make your portfolio stronger over time. So let's now deep dive into the specific fund we're talking about today, Hg Saturn IV. So first of all, let's look at the firm. So Hg is a very large Europe-based buyout firm, founded in 2000, so it's 25 years. They manage $75 billion, have 126 investment professionals. Over the last 24 years, they have achieved a net IRR across their various funds of 20%, with net total value over paid in of 1.6x. So they've done well, and they've done well consistently over the course of the last 2.5 decades. They are a large cap buyout focused on software. So they do software investment. This is in a way similar to our very first investment, which was Silver Lake, which we did 2.5 years ago, or around 2 years ago, sorry. Silver Lake was a tech buyout focused in the US. Hg does tech buyouts focused on Europe. Deal size is north of $1 billion US. So again, as I mentioned, it's considered large cap buyout. As usual, we're going to look at 3 lenses. The first one is historical performance. That's the first question, is how did the fund, kind of vintages 1, 2, and 3 perform historically? 2 is, how likely is the fund manager to replicate this performance? And lastly is, how does it fit into our overall portfolio? So let's start with number 1. So what is the performance looking backward? So first of all 3 vintages, so 1, 2, and 3, have been doing pretty well so far. Obviously, they have different ages. So Saturn 1 is now mature, and his return is an IRR of 21% with 2.2x total value on paid in. Saturn 2 and 3 are less mature, so the total value on paid in are smaller, but as you can see, IRR is actually similar. One thing to note is that Hg has been able to be very consistent in performance while increasing fund size very significantly. So Saturn 1 was $1.5 billion US. Saturn 2 was 5 billion. Saturn 3 is 11 billion. So they have actually scaled their strategy quite well. And this is usually something we look at and we might be concerned of if we see fund size increases very significantly. They have proven to be able to do this consistently, and actually Saturn 4 is going to be similar size to Saturn 3, so there's no further increase in size, and I'm going to talk about that later on. From a geographical perspective, their focus is Europe, and as you can see, Saturn 1 was UK, Germany, and Norway. In Saturn 2, they've done some allocation to North America. These are what they call transatlantic opportunities. So these are American companies that have a strong foothold in Europe, or they are building a strong foothold in Europe, or European companies that by going to the US, they now became more American than European just because of market sizes and market fit. In general, the rule that they are having for Saturn 4 is up to 20% allocation to these transatlantic deals. As you can see, Saturn 3, the North American allocation has actually pared down to around 20%. And everywhere in all the geographies, they've actually done quite well. So as you can see, kind of invested capital is mostly gone to the UK and Northern Europe, so Germany, Norway, with North America being large because of Saturn 2. And as you can see, everywhere they made money. So the dark blue line is actually larger than the gray lines. You should be familiar with the concept of J-curve as of now, but let me, if you have been part of the program for some time, but let me explain it again. So when you invest in a closed-end private equity fund, the returns will have a J-curve shape. What this means is that in the first 3 to 5 years, the fund will call capital. So while you do a commitment of, let's say, $100, in the first year, you're only going to invest $20. In the second year, another 20. In the third year, another 20. And that's your kind of net cash flow is going to be negative, right? You're going to actually send $20. Between the year 3, 4, and 5, the fund is likely to start having some liquidity events or some sales, in which case the kind of your net cash flow starts turning, and around year 3 or 4 usually is it starts going the other direction to break even. Usually the target is breaking even, so in practice getting back your full $100 by year 6 or 7, and then making returns in the following 4 to 5 years. As you can see, Saturn 1 actually broke even quite early in year 4. And obviously Saturn 2 and 3 is too early to see the shape of the J-curve, but they are behaving like you expect funds of 2 years old and 4 years old to be. Okay, so but Saturn 1 at year 6 actually is performing incredibly well from a timeline perspective, which speaks well of their ability of the firm to manage the timelines and the cycle and cash flow and return capital back. Comparing the 3 vintages, so 2018, 2020, 2022, with the S&P 500 as a kind of an alpha experiment, alpha benchmark, you'll see that actually both, all three have actually returned significantly above the S&P 500, which means, there has been alpha generated, 8%, 7%, 5%. To be fair, 2022 is still too early to say. So, 5% looks like a good number, but obviously the jury is still out. This is a very, very early fund in the deployment. While I would argue 2018 is definitely still mature enough. It's been 6 years, and as you saw before, also from a cash flow perspective, is now being the positive. So it's not too early to start looking at results this way. From a risk management perspective, they actually had 0% impairment ratio, which means no companies have returned less than what was invested. So 0%. So this is a decline in value. This is impairment here is defined as for every $100 invested in a single company, did you get at least $100 back? And the answer is yes in 100% of the cases, which is quite exceptional. For buyouts, you usually see, even in top quartiles, you see anywhere around 5 to 10%, 5 to 10% impairment ratio for kind of buyout. So this is actually quite extraordinary, which shows the strength of the sector and the relative strength of Hg in the sector. Now, so we looked at the past. We see that numbers look extremely good. The sector obviously makes sense. You're investing in software in a large region like Europe, focus mostly on Northern Europe, UK, Germany, Norway, Sweden. The risk management seems to be very strong, and returns have been quite consistent, which is usually a good sign of the replicability of the performance. But now let's ask ourselves a few questions on whether we see something changing. And we look at the fund manager, we look at investment strategy, we look at the team, and we look at key terms. On the fund manager, I talked about it earlier. It's a very kind of long-standing firms, 2.5 decades, managing $75 billion. As I mentioned, very large team. They've been around for a long time. It is considered one of the blue chip buyout firms in Europe, and definitely one of the most significant players for software buyout in Europe. I was as part of the due diligence, I was reading the statistics about returns in European buyouts from different fund managers, and actually Europe-based firms versus global firms tend to perform significantly better than global firms. So when you look at US firms trying to kind of build US buyouts funds, their performance is actually lower than the natively European funds. So that's one of the reasons why we looked for natively European funds to get exposure for Europe. Yeah. Now, this is just to give you a taste of what are the type of companies they invest in. We selected a few companies from all of the three funds. Visma, for instance, is a software company that provides accounting, payroll, HR management software for mid-size companies in Europe. They do kind of up to ERP. I've looked at some of the numbers. Obviously, these are all private companies, so there is some numbers shared in the due diligence that we can share, some others that we can't. We have some numbers on Visma that I can share. Is that the company has had actually 17 years of uninterrupted growth with CAGR of 18% on revenue. So every year, on average, they grew 18% year on year. And their EBITDA has also been growing with a CAGR of 22%. I've looked at the last year numbers, so 2024 versus 2023. Revenues have actually grown 17%, so in line with historical trends, and EBITDA has grown 27% above historical trends, which shows how the strengths of the business. EBITDA is now 900 million euros, so this is now a large company with close to 3 billion euros in revenues, and Hg is actually a majority shareholder of the company. So this is a good example of kind of a pure software provider, that has been scaling very significantly over time, and again growing 20% year on year with around 3 billion in revenue, starts to see significant growth. We're talking about 500 million a year in top line growth. PI is a HR software as a service, focus on German market and European Mittelstand, which means kind of mid market for Germany, Austria, and Switzerland, so German speaking Europe. It's a fully integrated HR platform, and for any of you working in HR or has to deal with HR, you know how important it is to have a good software and how difficult it is to have good ones, and that's why over time this has been kind of an interesting kind of a company that has built a presence in Europe. Maybe let me take another one from a different fund. I brought a couple of notes on Access. Access from Fund 3 is also a kind of business management software. They do accounting and finance, payroll, and HR. Focus on the UK and focus on the middle market in terms of size of the companies. They are valued at 9 billion pounds, so they are fairly large at this point, and have been growing again very consistently over the last decade or so. I don't want to go through all of them. The goal here is to show you, getting snippets of what type of companies they invest in. As you can see, it's all software. It's business software with a strong focus on accounting, on HR, and because of Europe being so parcelized in terms of languages and laws, especially HR laws, you tend to have local players actually becoming dominant in each market, and that's where there is opportunities for consolidation and there is opportunities for M&A for private equity. I want to add one thing, which is that with what's happening with artificial intelligence, and I'm sure all of you have heard this before, we are potentially entering a kind of a very interesting years in terms of how business software will change. And so actually investment done in the next few years, I think will be very, very, very interesting because there is going to be new player growing faster than maybe larger established players. And so a kind of a buyout firms like Hg can actually potentially play in an arena that is changing, and there are going to be opportunities out there. And there's going to be probably a lot of M&A, so there might be some liquidity in the market as well. From a team perspective, the team is very experienced. I mentioned earlier, there is 126 investment professionals, so it's a fairly large team. What you see on the slide is kind of the leadership team for Saturn, which is this particular fund. As I mentioned, they manage 75 billion, so they have a variety of different verticals. As you can see, there is the three more senior people on Saturn have been with the firm for more than 20 years. And the other people have been actually, there is Matthew Brockman also that have been 14 years, and Alan Klein, who's joined recently to actually lead North America, obviously because they've been for they're kind of starting to build transatlantic deals. They have to source people for North America, and that's what happened there. But very strong team. They've been in for a long time, so very stable. There are two things that we looked at specifically from a risk perspective. One is fund size. As I mentioned earlier, we usually, in our due diligence process, we get a bit worried when we see fund sizes increasing very significantly, and we deal because that can potentially change strategy, and try to spend time understanding whether there are enough mitigation in place. We think that for Hg Saturn, there are. In particular, there is actually not a big increase from Fund 3 to Fund 4. The big increase were actually 1 to 2 and 2 to 3, and they were able so far to show the same level of returns, even if, to be fair, Saturn 3 is still fairly early. They have built the team very significantly over this period of time, and they have increased their share in companies. So, when you increase fund size, you can work on three levels. One is targeting larger companies. Two is taking kind of larger equity positions. So instead of investing in 40% of the company, go to 60 or go to 80, go to 90, 90%. And in this case, and three obviously is doing more deals, so having more portfolio companies. And in this case, all three happen. So Fund 1 was actually very concentrated, while Fund 2 was a bit less concentrated, and Fund 3 is expected to be even less concentrated, so a bit more deals. They've increased, obviously, the target size of the companies that we've invested in, and they've increased also the share that they take in these companies. Now, it's very important to also think about what's happening to the market. And in the last decade, since kind of Saturn 1 was launched, kind of business software companies in Europe have become larger. As I gave you the Visma example earlier, growing 20% year on year for more than 15 years now. And that means that if you want to play in the area of kind of the leaders in each market, you need actually to target slightly larger buyouts, which is why they've kind of kept focusing on leaders, but the leaders are becoming bigger, and that's why they justify their fund size. So overall, while this is a little bit of an overall risk, we don't think that this is a risk that makes the investment unattractive. Actually, we think that is quite well managed so far. And actually, team changes, as I mentioned, there's actually not been significant team changes. There's been an increase in team size, but not a loss in partner. And increase in headcount has been in line with the increase in size of the funds. As a recap of the terms, focus is Europe with up to 20% transatlantic deals. This is a large cap buyouts focus on software, 11 billion target, sorry, 12 billion target size. The previous vintage was 11 billion. Around kind of north of 1 billion, 1.2 billion US dollars, so a bit more than 1 billion euros in target investment size per deal. So we're talking about 10, 12 deals throughout the life of the fund. This is a classic 10 plus 1 plus 1 term with 5 plus 1 investment period. Management fees on the lower side because it's a large cap size with 1.35% per annum during investment period and 1.1% thereafter. Classic carried interest of 20% with the 8% hurdle. So this is all standard terms. Actually, I would argue on the lower side for management fee. So kind of a check mark in terms of due diligence. The third point is once we have looked back at historical performance and we look at whether things have changed in a way that makes historical performance difficult to repeat, the third part is how does it fit into your overall portfolio? And I showed you the program earlier. So what you see on the slide on the left side is geographical allocation, on the right side is strategic allocation, right, from a strategy perspective. We were slightly underweight Europe before, or we are slightly underweight Europe before this investment. We allocated 20% of a yearly budget to Hg Saturn, so we're now going to 220% for whoever started kind of at the very beginning. And this actually will lead us to be slightly over allocated to Europe to 24%. The target is 20%. Over the course of the next 2-3 investments, we're probably not going to do Europe as the next 1 or 2 investments, and therefore the 24% will go naturally down toward 20% as per target. As I mentioned earlier, we actually significantly underweight Asia. We're at 5%. The target is around 20%, and kind of the delta is mostly in the US. We will, over time, trying to kind of increase Asia allocation. It has been difficult because China has been a bit difficult to invest over the last couple of years. But I do think personally, for instance, that there are actually significant opportunities, and we're looking for opportunities in the Chinese market, especially I think there is opportunities in secondaries, just because the market has been dislocated so significantly over the last 2 to 3 years. From a strategy perspective, we are now, after this investment, we're going to be at 18% buyout, sorry, 71% buyout, 18% growth. So we are slightly over the target is 60%. We are slightly underweight on growth. We've recently done one with CVC, but we're still slightly underweight. So this actually increased a little bit buyout by 3 percentage points. Again, we'll focus on trying to bring it back to the 60 to 65% range for buyouts over time. But the reality is that we privilege the quality of opportunities toward being exactly on target. We're also in advanced stages of due diligence on a VC fund, so we might actually increase our and actually it could actually lead up to 2 allocations, 1 to VC, 1 to growth. So that actually could help bridging this gap. Yeah. Vincent, do you want to take it from here and explain how to get started?
Sure. So I'll be taking over this portion whereby how do we actually get started to get invested in PEVC with StashAway. Next slide. So first and foremost, we have to actually look at overall portfolio to determine what's the budget or amount that you wish to invest in PEVC over the next 12 months. So with this being said, right, it's always good to have continuous conversations with your wealth advisors so that they will help you give you a better idea how much should be the sum that you should allocate into private markets. And of course, we have to take into consideration things like the illiquidity of private markets. So ideally, as what Michele has shared through the presentation, that we will invest your annual budget into 5 to 7 funds in a diversified manner, different types of asset allocation and also geographical and across multiple private market fund managers. So we also do the due diligence and handle the legal complexities on behalf of clients. And we also do the capital call management for clients, where clients do not let their funds sit idle while waiting for capital calls to happen, right? So we always advise clients to put it in US dollar cash yield, and we will handle the capital calls on behalf of clients. So next slide. So all in all, we pick the best managers in the industry. And as I think Michele has kind of like walked you through the kind of decision-making process when we pick a fund to allocate into our clients' portfolios. So at times for clients that do not have experience in private markets, it might seem a little intimidating for them to start investing in private markets. That is why we do the due diligence for clients, and so that we kind of handhold clients into the private markets investing. So simplicity, we source, we analyze, and we allocate investments so that you don't need to do your own due diligence, and our target asset allocation builds your optimal portfolio. And last but not least, it's low minimums. So as you know, if you were to want to gain private market access in traditional FIs or financial institutes, the ticket sizes are looking at 125,000 US dollars to 250,000 US dollars per fund. But at Stashaway, we want to help clients size private markets access in a better manner. So the minimums here is looking at US dollar 50,000, and it's spread across 5 to 7 PE VC fund with a target asset allocation that we want to achieve with your 50,000. So the annual budget term that we use here might be a little misleading, but it just basically refers to the budget that you are planning to invest in private equity or venture capital investing over the next 12 months. So with that being said, yeah, so we kind of handhold clients, even for sophisticated clients, but they are very well versed in the private markets. You still can use us to gain access into private markets, because we allow clients to actually allocate on this full discretionary basis, whereby we decide the allocation and we'll allocate on your behalf and we'll inform you. Or you can actually opt for the flexible allocation, whereby you can let us know if you are keen in taking up, for example, the Saturn 4 fund, and tell us what the percentage allocation that you are looking to allocate towards this fund itself. So we are definitely here for the savvy investors, and also those that want to start out into the private markets investing. So next slide.
Yeah, so maybe, yeah, so thank you, Vincent. I just want to add one thing before I show a little bit of the video on a portfolio. One thing, even for sophisticated investors in private equity, and I used to work in private equity. I understand the asset class quite well, and this is the first time that, as a client myself, I feel that I can actually build a portfolio like an institutional investor. And one of the things, obviously, access is one point, and due diligence is a second important point. But another very important point is that if you want to build a portfolio of 2025 private equity investments, you will, and if you want to manage them directly, you're going to have capital calls every week. It's going to be a complete nightmare. So we make that process extremely easy, because we manage the capital calls and the distributions. And that, I think, is the only way for a busy professional like all of us to actually have a proper private equity allocation. The alternative is semi-liquid, but there are pros and cons to that. So let me show you how this works. So what you see here is actually a video on the app, so on Reserve app, so PVC. This is a real portfolio with an annual budget of 100K. So this is a double the minimum of someone that has actually done since the very beginning. So and you can see 13 funds invested, $215,000 capital. And what you see here is all the funds I mentioned earlier, so Clear Lake, Hg, Silver Lake. What you see on the right side is the commitment. So this is double the minimum, as I mentioned. So you could actually have half of this. You have the buyouts, you have secondaries here, the Hamilton Lane and Lexington, you have growth equity, CVC and KKR, and venture capital, General Catalyst and Khosla. You can also look at weightage and as you can see here is 5 to 10% each right now. You can click on each of them. This is a Clayton Dubin Rice. This is now a 1.16 times value invested, so it's a 16% return so far. It's one of the earlier investments. The secondaries have a faster J curve, so they're already at 20%. This is Lexington Capital Partners. Hamilton Lane is actually at 28% right now. While if you actually look at the earlier investors, the later investors like Khosla Venture, the J curve actually shows like 0.98, which means that in practice the portfolios are still at 1x minus the fees is actually slightly below that. So hopefully this gives you a little bit of overview of how it works. I'll play the video once more in case you want to double check on something. But this is the way you would actually see it on the app. So it's a good way to have a kind of a good overview of where your money is invested with some kind of significant details on each of the funds. And then on a quarterly basis, we actually send a PDF with updates on each of the funds, the latest valuations, and the status quo. Okay, and I think maybe I'll move on from here. Okay, here it is. So
feel free to speak to any of us because you can't actually create the portfolios on your own on the app itself. So there's me, Janelle, and Kimi. So reach out to any of us to find out more if you want to understand more details on the mechanics of PEVC investing at Stashaway, or if you are looking to create a budget to let us know, reach out to us and we'll help you set the budget.
Thank you, Vincent. And I saw there was a couple of questions from Marco, so let me try to address them. So the first one is, could you please share the performance after if clients investing into all PE investments since launch? So it's still very early, meaning that we are still in the part of J curve. I actually don't have the exact number. Performance is, there are a bunch of funds that are 1.0x. So the NAV has not moved, which is what you expect at this point, especially for the last year's vintage. The older ones, as I showed you earlier, there is a Claytor to be rise at kind of as 1.16 valuation. There is the two secondaries. One is a 1.2, one is a 1.28. I don't have an IRR number. If I had to guess, one is probably in the high single digits, but it's too early to show it. The expectation here is to actually deliver high teens, so 15 to 20% net IRR over a period of time. But it's just too early because the average duration is a year in practice, or maybe 14, 15 months. But again, target is high teens, 15 to 20% returns net of fees over time.
Yeah, I think sometime in February, right? We have actually sent out latest update on our PVC funds that we've allocated in our client's portfolio so far. So maybe Marcus, you can reach out to your wealth advisor, and the wealth advisor is able to provide you with more insights onto the portfolio itself.
Yeah, exactly. Thank you, Vincent. And what I showed you earlier on the kind of the video on the app is actually shows all the portfolio, all the investments since the very beginning. So Silver Lake was the first one. And there, you could see the kind of, again, I only clicked on 3, but you can see kind of some of the performance. Obviously, again, as I mentioned, it's too early because of the J curve effect. It'll take time to see NAV move up significantly because that's how private equity works, right? So people they invest and they tend to be conservative over the first 1 to 2 years valuations, and then as revenues start to continue going up and EBITDA goes up, then valuations get adjusted over time. Second question, also for Marcos. What risk do you see that AI agents replace traditional software and hence pose risk to Hg? I do think, as I mentioned earlier, that there is going to be a potential for significant disruptions in the software market over the next 2, 3, 5 years because of AI. And I think this is actually an opportunity for private companies, meaning that remember that the large software companies are public companies. They are the SAPs of the world. And that's why actually I do think that investing in private markets, and here I'm including buyouts, but I'm also including growth and venture, obviously, can play as a bit of a hedge over technology risk, because in practice you're getting a part of your portfolio is exposed to younger companies, smaller companies, not public yet, that they are obviously more nimble in developing new technologies, in attracting the right talent. So I was, as you can imagine, because of my job, I spent quite a bit of time, talking kind of in the tech industry forums, and I was debating with a founder of a HR, actually not HR, it's customer support software company. And I was asking him, what do you think is going to happen to the Zendesk of the world, which is a larger customer support listed company? And his perspective was, look, they're trying to adopt AI, but they actually struggle to attract the engineers because AI engineers prefer to work in nimbler companies that are, maybe they have, shares, stock options in the companies, which, private companies tend to, especially private equity-backed companies, tend to give more than public companies. And so there is a bit of a structural advantage in being a smaller player in today's market, I think, if you are in software. Now, I mean, obviously, I'm making a very broad statement and take it with a grain of salt. But I do think there are opportunities. And I think being exposed to private markets provides an edge to your public market investment, which you should have. I'm not saying you should abandon public markets. I'm saying you should have your 60, 70%, equities and bonds portfolios, but having your 10, 15% allocation or 20% to private markets, both credit and equities, I think actually gives you a little bit of a broader exposure that is important to have. I hope I answer your question, Marcus. Any other questions? If not, I will close the call here. If you have any follow-up questions, feel free to reach out to Vincent, Janelle, Kimi. You can, you see all the details on the page here. There's also a QR code to connect directly with them. And, they will be able to answer any questions and share more detail on any follow-up you might have. But thank you so much for joining. Thank you, Vincent, for joining and helping me out tonight.
Thank you, everybody.
And looking forward to engaging with all of you at our next event. Bye. Thank you.
Goodbye.